So to find the real intrinsic value of Starbucks and figure out at which price you should be thinking to buy the company, we'll jump over to our stock valuation spreadsheets where we will plug in the ticker SBUX and all the metrics will show up automatically. Now make sure to watch this video until the end, as I will not only show you how to figure out the intrinsic value of Starbucks, but how to find the intrinsic value of any company. Also, if you want to download these valuation spreadsheets for your own personal use so that you can evaluate any stock, you can do so at my Patreon in the link in the description. Now, first of all, as Starbucks is a dividend company, let's have a look at their dividend summary. Currently, the dividend yield is sitting at 2.38% and the annual payout is sitting at $2.28, which isn't bad at all for a growth company. As we can see, the company has been growing at about 9.24% every single year in dividends over the past 5 years. Now, the payout ratio of the company is sitting at 63.87%. Now, the way I like to evaluate the payout ratio is by having a look at the trailing free cash flow payout ratio over the past 5 years, as dividends are always paid out from the company's free cash flow. And by looking at the trailing payout ratio and not only the payout ratio of a single year, I really analyze the sustainability of the dividends through the long term. And as we can see, the trailing free cash flow payout ratio is actually quite higher than only the payout ratio, which gives us a much better insight into the company's dividends and into the dividend sustainability over the next few years. Now, to further evaluate the company and understand whether they will be growing within the next few years, we have to look at their historical data. And for that, we will jump to our 9-pillar analysis, where we will have a look at the 9 most important metrics every value investor should consider when buying a company. So first of all, we want to see the 5-year PE ratio and the price to free cash flow to be below 22.5 and below 20. And this will show us that the company is trading at a fair value based on their earnings and based on their price to free cash flow. As we can see, this is not the case with Starbucks, but as Starbucks is a well-established company that has been in business for a very long time, this is quite fine. Now, the other 3 metrics we want to have a look at is the revenue growth, the increasing free cash flow, and the net income growth over the past 5 years. As we can see, Starbucks has been growing all 3 quite well, and if we scroll down to the graphs, we can indeed see that the net income and revenue have been both increasing steadily. And if we scroll further down, we can see that the free cash flow has been increasing steadily as well. Now, scrolling back up, I want to have a look at one very important metric, and that is the long-term liabilities over the 5-year free cash flow and negative dividends. And what this metric tells me is that the company generates enough free cash flow to cover its long-term liabilities while paying out their current dividend. And as we can see, I ideally want this value to be below 3, which would mean that the company can pay off all their long-term liabilities within about 15 years. Now, Starbucks' value is sitting at 6.76, which means that it would take them about 35 years with their current free cash flow to pay off all their long-term liabilities while paying out their current dividend and not increasing it every single year. Now, to visualize this metric better, we can scroll down to the graphs and have a look at the shares outstanding, the quarterly dividend growth, the long-term liabilities growth, and the free cash flow growth. Ideally, we want the free cash flow and the quarterly dividend to be rising while the shares outstanding and the long-term liabilities are decreasing, which would mean that the metric up here would be decreasing as well every single year. Now, with Starbucks, we can see that the long-term liabilities are increasing slightly, but the free cash flow is increasing as well, and the shares outstanding are decreasing, which means that the company pays less dividends every single year to their investors. And now we can jump to calculating the company's intrinsic value, first using the Graham's formulas revised. And here we will take the earnings per share, the base PE 5-year growth estimate, growth rate multiplier, the average yield on A corporation bonds and the current yield on A corporation bonds, and get an intrinsic value of $87, which is currently 9% lower than the current trading price, meaning that the company would be overvalued compared to their earnings per share, meaning that the company would have to have higher earnings per share to compete with their current trading price. But now let's jump to the second valuation model, which is the discounted cash flow model. And here, as the title hints, we will evaluate the free cash flow of the company over the past 5 years. So we'll take the average growth rate to be sitting at 940%. As we can see, this percentage is not quite right due to the growth in 2021. So based on the research I did in the back end and based on the analyst growth rate projections over the next 5 years, I will calculate a growth rate of 6.2% over the next few years. And using this, I will calculate the future free cash flow and the terminal value. Now, to calculate the present value of the future free cash flow, which is the value of the free cash flow including inflation, we have to plug in a discount rate, which I will plug in at 6.5. And plugging that in, we can see that the intrinsic value of the company comes out to be $85.18, which is again about $10 lower than the current trading price. Now jumping to our third valuation model, which is the multiples valuation model, and here we will compare Starbucks to its competitors such as McDonald's or Chipotle. So we will take these companies' stock prices and divide by their earnings per share to get their PE ratios. We'll then average out these PE ratios and multiply by the earnings per share of Starbucks to get an intrinsic value of $107, which is indeed about $20 higher than $10 higher than the current trading price, showing us that compared to its competitors, Starbucks might be slightly undervalued. And finally, let's move to our dividend discount model, where we will evaluate Starbucks' dividends. So we will take the yearly dividend over the past 5 years and calculate the average growth to be sitting at 22.94%. Now, as the growth in dividend from 2019 to 2020 was a large outlier, I will be conservative and project a growth rate of 8.5%. Now I'll also have to change the discount rate to 6.5, which we plugged in our discounted cash flow model. And as you can see, the intrinsic value comes out negative. And the reason for this is that when the projected growth rate is higher than the discount rate, due to the mathematics within the model, the intrinsic value comes out negative. And therefore I have my alternative model, which bases the stock price on the next year's dividend, which we calculated through our projected growth rate, the stock price next year predicted by analysts, and the discount rate, which we plug in right here, and this gives us an intrinsic value of $105.46, which is quite similar to our multiples valuation. And now let's jump to our final valuation, where we average out the four models and get an intrinsic value of $96.16, which is 1.35% higher than the current trading price. Now, if I plug in a margin of safety of 20%, I would get an acceptable buy price at $76.93. And looking back at the graph, this is indeed a value the company has been trading at over the past 6 months. Now, personally, I did sell about 80% of my own Starbucks shares as I saw a huge profit, and I do believe that the company will go down in price within the next few months, and that is when I will buy it back again. And with this, if you did enjoy the video, make sure to leave a like and let me know down in the comments which company you'd like me to evaluate next.